Hello, Louis Yanis here. I know I'm having a little bit of a connection problem to the Facebook accounts right now. There's some kind of a issue going on there. I'm going to try those again. But if you're joining me right now, today I want to talk about what to do during a sell-off. Today we had a little bit of a sell-off in the stock market. And, I had an interesting podcast interview with Dave Keller, who is a former director of research over at Fidelity Investments. And we were talking about the fact that there's a kind of a stealth bear market that's going on right now because the stocks underneath the market tend to be correcting, yet the overall general market looks relatively either drifting higher or kind of just going sideways. But if you look underneath the hood and if you look at the stocks in the market themselves, many stocks are below their 200-day moving average, or they've had a 10% correction or more and are significantly off their highs. So a lot of people are not getting that translated into actual results. So I wanted to talk a little bit about what we are doing right now. We have been raising some cash, and that has really stabilized the portfolio in the last week or so, because as you may have noticed, there's been a decline, a little bit of a decline. So we're on the higher end of our cash allocation right now. But the thing to be doing in this type of environment is to be looking underneath the hood and to be looking at the companies that have good fundamentals, a good fundamental setup, good growth patterns, good new products and services, revenue growth, trading at a reasonable price, and to find those companies that are still trending positive and that maybe they're in a minor correction, but they're outperforming the market and they are looking like they are making what's called a base, which is basically a period of time when stocks may come down a little bit. You don't want them to come down much, but they come down a little bit and then they start moving up and down in price. And then you could see the smart money is accumulating these stocks. And there are some companies that are actually making those characteristics. So we're really fishing and looking for opportunities in this type of environment. A lot of people are actually thinking about, selling more right now. We have been doing some selling as well, but it's time to, taking profits on some and minimizing risks with others. So, but you also want to be looking for those opportunities that are underneath the hood. And one of the ways you could do that is or one of the ways we do that is by screening stocks. And for me, that is a good way to kind of see, doing quantitative screens to see what is happening with individual companies that you can potentially add to your portfolio. And in the long run, that adds value to results. And to give you just a little bit of an example, one of the things you could do, and one of the things that we do, is we look at the trends, the absolute trend and the relative trend. And absolute trend has to do with, is the price moving higher on an absolute basis? The price itself is moving up. A relative trend says, is this particular trend stock relative to the market trending higher? So looking for those companies that have the strong trends. And then also, they're near the highs, like how close are they near various highs over various time frames. And you want to weed out stocks that are overly volatile. We did a statistical analysis, and if you look at all the publicly traded stocks in the United States and you look at their daily volatility, we look at the daily standard deviation of the returns of the price, and you compare that to the market. You can do kind of a volatility scaler or a comparison. And what we found is that it makes a lot of sense to keep stocks under around 3%, 3.5% in daily volatility, because you don't want to own a lot of high volatility securities when you're managing your risk, because you have a higher probability of having an erroneous decline. And based on how we position size, putting money in the markets and in investments, we want to make sure that we can size correctly. So if we have investments that are overly volatile, they don't meet our risk parameters for sizing as well. And we also want to have a lot of liquidity. You don't want to have stocks that are really thinly traded in this kind of market, or really in any market. We're not big on that. Generally, I like stocks that are trading over $10, $12 a share, that are have at least a year's worth of data. They've IPO'd a year or greater than that, and that they've rallied from the low over the 52 weeks for like maybe 30% or more, and they're close to their highs, within 30% of the highs of the year too. And of course, they're pricing above moving averages. They're trending above moving averages, and that screening process can give you a list of companies that have a higher probability of having further price progress. So this is the time that you want to be doing that. You want to see which companies that have the strong fundamentals are actually displaying these properties, because what it means is that institutional smart money is actually accumulating the stock underneath. And what I've noticed is a lot of stocks that everybody owns right now, like the Microsofts, the Amazons, the Apples, those stocks are actually being sold, and they're being rotated into other stocks that have better values, better growth potential, and are not so overpriced. So that's one of the things that I think makes a lot of sense in this market. That's what we're doing in this market, is looking for that. So look at the relative strength, look at the revenue growth, look at the earnings per share growth. I like to look at the earnings estimates and the revenue estimates to make sure they're moving higher and their estimates are moving forward. They have new products, new services, good management team, strong margins, and maybe even margins expanding. So profit margins are getting better. They have good quality, strong balance sheet, trading at a reasonable price, good liquidity. You want to have, we like to look at the dollar volume. So recently, the statistics we looked at, the median stock right now has about $20 million of daily dollar volume. So that means take the price today and you multiply that times the average volume over the last 30 days. And that tells you kind of on average how much money is being moved in that stock. And I like to see stocks that have daily dollar volume above or equal to $20 million. And the volatility is under 3.5% or so, volatility under 3.5 on a daily basis. And then look for these companies. And this is what you should be doing. And this is what we like to do when the markets when the markets are coming off. Luckily, we are already heavier in cash. So that's something that you have ways that you want to take money off the table when you're making a profit, and then you have ways that you want to take money off the table to manage risk. Right now, we're doing a little bit of both, actually, but primarily we're really scrubbing to find those companies that are the opportunities, so that we can be poised to be in those names that rise out of the decline that we're in right now. So just a little bit of something to think about, and I hope you're having a great day. I'm getting ready to go do a little exercise and go see my family, and we will talk to you later. And by the way, keep an eye out for our podcast. Go to and subscribe to our podcast. We have a new podcast. It's called The Market Call Show. You can get that on Spotify or Google or Apple, your favorite platform. Check it out. We have some great people that we're speaking with on various topics about managing money and financial planning, things that affect your wealth. And jump on that, and hopefully we'll see you there. All right, that's it for now. We'll talk to you later. Bye.